welcome to Market Domination. I'm Julie Hyman, Ali Cannell in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's a headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
What we're seeing is a very broad-based conclusion or opinion among consumers that inflation is going to pick up in the year ahead as well as the next 5 years. It was a pretty large month-over-month increase for both short and long-run expectations. It's not necessarily cause for panic at this moment, but these expectations are clearly being driven by concerns over policy, concerns that tariffs are going to lead to price hikes, and it's very anticipatory on the basis of consumers.
Our view is that there's still upside for the S&P between now and year end, but between here and there is probably an ongoing period of volatility concern that keeps us looking for pullbacks as better buying points.
Let's take a look at United Health Group, responding to the Wall Street Journal report that claims the Justice Department is investigating the company's Medicare billing practices. United Health Group says the journal, quote, continues to report misinformation on the Medicare Advantage program. The journal's report claims the new civil fraud investigation is examining United Health's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans.
We got 1 hour to go until the market close. So taking a look at the major averages, the selling is worsening as we head to the weekend. You know, there's an old market view that you don't want to be long into a weekend if you've got the sell-off happening. Maybe that's part of what's going on here. But we did get some economic data today that disappointed. So right now, the Dow is down 780 points, 1.7%. The S&P down 1.7% as well. And by the way, for both of these averages, it's the worst sell-off since that Fed meeting on December 18th that triggered a market sell-off. The Nasdaq down about 2.2% today.
Yeah, just an ugly day on Wall Street. You mentioned some of that economic data. We have consumer sentiment falling once again for the month of February. We have long-term inflation expectations over the next year and also the next 3 to 5 years rising sharply again for the 7th straight month. Now, despite that, we are seeing yields under pressure a little bit since there's this risk-off sentiment in the market right now. You're seeing yields hovering around that 4.4% level. So it's one of those things where when you have bad economic data, we have these TBD factors of tariffs and some of those policy concerns. And as you mentioned, heading into the weekend, not a great picture on Wall Street.
Right. So even though those inflation expectations may be ticking up, some of the other economic data we got today, whether it was existing home sales or a PMI reading on services that showed contraction, you know, it's a complicated picture, I guess, is the bottom line. But we've also got some individual stocks that are really pushing things around here today. This is a look at the Dow components. I'm going to equal weight it so that we can get a clear look at United Health falling by nearly 7%. This is on reports that the government is looking into the company's billing practices, particularly for Medicare Advantage. We're going to get some details from our Anjali Kamlani later. But you see, obviously, what's happening with the stock.
Yeah, and the sector action is interesting as well because consumer discretionary is underperforming the market there, and it actually has erased all of its gains that we saw since the end of November. So definitely not a great picture on the consumer side. And it's interesting, Julie, because heading into this week, we had all the sectors in the green. Things felt good. We had record highs. And now we're seeing us end the week on a slightly more sour tone.
Yes, most definitely. So let's talk more about the outlook from here. We did get more signs of weakness for the U.S. economy, taking a heavy toll on the market today. 3 separate economic reports, all coming in below economists' expectations. First up, that reading on the services sector, contracting for the first time in 2 years. Consumer sentiment falling to its lowest level since 2021 in February, and a reading on existing home sales tumbling by nearly 5% last month. Stocks sliding across the board as a result of all of this. The major averages now on track for weekly declines. Joining us now, Michael Darda, Roth Capital Partners chief economist and macro strategist. And Mike, really, you are the perfect person to talk to about this because what we're seeing does have a heavy sort of economic component here. What do you make of what we're seeing today?
Well, this is still a fairly minor pullback after a 2-year period of totally uninterrupted stock market gains for the S&P 500. So not at all surprising considering how high valuations have gotten. And the reality is we've got a lot of policy uncertainty in front of us. The Fed is on indefinite pause now, more concerned about some recent warm inflation readings. You mentioned the University of Michigan data for February. That 5 to 7 year inflation expectation reading is at the highest level since 1995. Now, the mid 90s were not a particularly inflationary period, but I don't think the FOMC is, it is flattered by the direction, which is up and to the right. It's not what they want to see. And then, of course, you have a fairly chaotic policy environment brewing in Washington with tariffs on and then tariffs off and then tariffs on again, stricter immigration policies that'll slow down labor force growth. So if those things are hurting the supply side of the economy, and now we've got news of some kind of gimmicky Keynesian rebate with so-called Dodge savings, which is the wrong policy. Look, if the Fed is worried about inflation and it's on pause because it doesn't want excess demand to push inflation or to continue to elevate inflation above target, if you come in with a tax rebate that potentially stimulates demand, the Fed could go back to hiking interest rates in that environment. So it's a bit of a mess from a policy perspective, and that mess is occurring with very high stock market valuations on a historical basis.
And there's also a lot of unknowns surrounding that mess, right, Mike? Because when we think about the tariff situation, the only levies that have been implemented have been those 10% tariffs on China. Everything else is TBD. You mentioned the consumer sentiment survey, those long-term inflation expectations. That's been anchored on these tariff fears. So do you think the market is overreacting a little bit to some of the headlines that are out there, and we should take a more wait-and-see approach?
I think on the inflation side, there could be a bit of an overreaction going on. There are some other surveys that come out of the New York Fed, and we've got data just in the past week that showed very anchored inflation expectations. The bond market inflation expectations readings still look okay. They have been moving up on a 10-year horizon. In the 240s, that's a pretty good level. That's consistent with the Fed hitting its target over time, since the PCE deflator, which is the Fed's formal target, tends to run a little below the CPI inflation rate. And that's what those tips are based on. If you look at the shorter horizon bond market inflation expectations, like the 2-year and the 5-year tip spread, they've risen quite a bit. And so I'd like to see those actually break lower. So, there are some warning signs here. I mean, it's really an environment where we've had the Fed pull a rabbit out of a hat. They were able to hike interest rates 500 plus basis points, slow inflation, slow nominal growth, and not kill the economy. I mean, it's really historic, a black swan in a good way. So at that moment in time, you've got high valuations because of a lot of optimism over AI and the business cycle soft landing. And now we're taking risks, tinkering around with tariffs and trade policy in a chaotic way. We know the immigration situation was going to be addressed in one way or the other, but that will slow labor force growth. So, if the tariffs hurt productivity, if labor force growth is slower, the supply side, the growth potential of the U.S. economy will weaken, and that could make the Fed's job more difficult in terms of gauging inflationary pressures and calibrating short-term interest rate policy. So it just seems to me like we're taking risks in an environment where you're priced for no risk.
Well, and on that point, that last point, Mike, I've seen a meme a couple times online about the markets here where they react negatively to a headline about tariffs, for example, and then the market sells off a little bit, and then investors remember, according to this meme, that the president cares about the stock market, and things go up again. Do you think that there is sort of a complacency here about the president's attachment to the stock market and about his unwillingness to do things that will indeed cause market pain?
I do. I think that could be a real gross miscalculation on the part of investors that Trump's second term is going to be focused on babysitting the S&P 500. he hasn't tweeted about the stock market in a little bit, and he tweets about pretty much everything, or sends out social media posts, and whether it's Truth Social or X. So, we could be in a situation where the focus is really on reshaping the global trading system and erecting these tariff barriers, to address imbalances, real or perceived. And if the cost of that, recently the president said the cost, could be a, bit of a disruption, but he thinks people understand that. So maybe he's not going to be so concerned if there's a stock market correction. And the question is, if you do get into a corrective shakeout, and I don't think we're there yet, this could be the front edge of it. But investors have been rewarded for buying every single pullback, and eventually that won't work. And when it doesn't work, it could be watch out below. And at that point, is a social media post and a quick verbal U-turn going to be enough? It may not be. So it's a very good question, and I do think investors are really just conditioned to assume that stocks only go up. We don't have corrections, we don't have bear markets, we don't have recessions, we don't have policy shocks. All of which, if you look at the historical track record, would be sorely, sorely mistaken.
So as an investor then, how do you play this market and really navigate a lot of that volatility? Well, I think hedging and diversification is really the name of the game here. I just, before we started the interview, brought the S&P 500 10 or 11 major sectors up on my screen. And as it turns out, even when the market was making new all-time highs, we were being led by a lot of the traditionally defensive areas. Consumer staples, healthcare is the top performing sector in the S&P 500. So we've advocated for some time on your show and others that investors use a barbell approach, that they have some safety in the portfolio, some shock absorbers, whether that's treasury bills or longer term treasuries or defensive equity sectors. And then if there's a portion of the portfolio and you want to go evil Knievel and chase momentum and super high valuation stocks, fine. But understand the risks on both sides. It's not just free money straight up into the right all the time. And unfortunately, I do think there are a lot of investors that seem to believe that. And I've heard a lot of anecdotal stories about folks who are in their 70s who have totally undiversified portfolios in the 6 or 7 names that have dominated the S&P 500. And they think they're bulletproof because everything's gone straight up for 2 years. And it wasn't long ago in 2022 where those areas took a very steep fall. And we certainly know what happened after the internet revolution, and that was transformative. But we also ended up with a nearly 3-year bear market on the backside. So that's what I would tell investors: diversification in balancing out the portfolio with barbell strategies, I think, is super important, especially at a time like this of high valuations and rising policy uncertainty.
Michael Darda, it is always a pleasure. Thank you so much. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, we're tracking the market sell-off all hour as we count down to the closing bell. We got to look at the biggest movers, including 2 key names to watch in the healthcare space. Everything you need to know straight ahead.
Wall Street awaits NVIDIA's fourth quarter results next week. The options market, though, is anticipating approximately a 7% move higher or lower in the stock following earnings. And what's notable about this, Julie, is that 7%, that's a little bit less than what options had expected in prior earnings over the past 2 years. Now, to keep it all in perspective, 7%, you're still either erasing or creating about $240 billion of market cap. Right. But for a company like NVIDIA, which is so volatile and has been so important to the stock market and the rally that we've seen over the past 2 years, perhaps this implies that maybe it's not as important. And you actually wrote about this morning in Yahoo Finance Morning Brief.
I did, just because the Magnificent Seven has not kept pace writ large with the market gains that we've seen this year. NVIDIA, which accounted for 20% of the gains in the S&P last year, has accounted for about 5% or so of the gains this year. But it's also a more diverse group of stocks that is leading gains this year. JP Morgan's on the list. Walmart was on the list at least until the losses that we saw after the earnings. So we have seen a bit of that market broadening. But in terms of how people are setting up ahead of those numbers, earlier today, our Yahoo Finance colleagues talked to David Bull about the options action. He's Baycrest Managing Director of Equity Derivatives, and here's what he said about that setup.
The setup I'm seeing from clients is that it's certainly less overowned than it was over the last 2 years. The numbers are likely to be pretty strong, but how good could it be with the rest of their major customers already reporting big CapEx numbers? I think the sense is, what can they say that's going to really drive NVIDIA up another 20% in one day? But if anything, this could be an overhang removed, and the stock could then grind higher over the next couple weeks or a month.
The sort of stunning reports that we get from NVIDIA might be behind us, just because it's more of a known quantity now, even though it's not growing at triple digits anymore in terms of revenue, even though revenue is still predicted to grow 73%, which is still huge, pretty mind-blowing, especially for a company of that size. But nonetheless, it doesn't any longer, well, maybe it does. I'll say this, and then NVIDIA will make a fool out of me. It doesn't necessarily have the same ability to surprise the market to the same degree.
And we've seen this broadening out of the market too, like you were alluding to. It's not just all about the Mag 7 anymore. It's not just all about NVIDIA carrying those gains. Revenue, like you said, has been slowing. I am curious to hear if they say anything interesting about the DeepSeek sell-off that we saw, or maybe the competition, things like that. But overall, markets seem to have largely shrugged that off and maybe interpreting it as a possible good thing when it comes
potentially, yes. And of course, the one other thing, we'll be looking for any commentary on Blackwell, on whether the company's manufacturing ability has sort of caught up here, where the supply is catching up with demand. That's going to be important.
Yeah, catching up with demand, and I feel like overall, all the Mag 7, the hyperscalers, they've been spending, so I feel like the demand picture likely going to remain pretty steady at this point. But while there will be lots of focus on NVIDIA earnings next week, we are taking a look at the bigger chip landscape today. The group as a whole is positive on the year, but that doesn't mean every stock is in the green. While Intel has seen its stock surge nearly 25% on acquisition reports, Skyworks is down 25% so far this year. Joining us now to help make sense of this sector is Christopher Danley, City Head of U.S. Semiconductor Research. So Christopher, let's start there. We've seen a lot of dispersion within these semi names. So how are you advising your clients to really kind of parse through all these various companies and really what the market is telling us right now?
Sure. So first of all, we start with the cycle because the cycle determines largely the movement of semis overall, and we're still positive on the cycle. When it comes to, say, an Intel or a Skyworks, Skyworks lost a major design win to Broadcom, so that's what's weighing on them. It's in an area that's commoditizing, so we don't like Skyworks. Intel, like you said, has really bounced hard. I think a lot of that is short covering, to be perfectly honest. I think Intel's been one of the more popular shorts out there in semis. And then whenever you introduce some unknowns, such as breaking up the company, government's getting in there, the shorts just sort of back off and say, hey, I don't know what's going on here. I think that's largely what's happening there. But as far as the space goes, like everybody else, we're still very, very positive on everything AI. So that's NVIDIA and Broadcom. But also, I think you're seeing other parts of the sector that have been down in the dumps for the last couple of years, like semi-equipment names, like Applied Materials and Lam, or the analog space, which has done absolutely nothing for the last couple of years, is finally showing some signs of life. I think that was the most important new development that came out of earnings. We upgraded one of those names, NXPI, earlier this week. We upgraded a couple of them throughout last year, Texas Instruments and Microchip. I think that's going to be one of the bigger surprises this year. And we're saying to investors to allocate like new dollars over to the analog names.
And where are we in that analog cycle that's leading you in that direction, Chris?
Sure. So a couple things. If you look at the like the margin trajectory of these analog names, unlike say AI, where margins for those companies are at all-time highs, for the analog names, they've largely fallen anywhere from 10 to 15%. Take a company like Texas Instruments, for example. Their margins have fallen 15%. That's the biggest decline in their margins since the global financial crisis. Obviously, it doesn't happen that often. Also, if you look at the revenue for the analog companies, it's down on average 30% from the peak of a couple of years ago. So clearly you're trending below consumption there. We're starting to see some signs. We've had multiple companies talk about their bookings increasing from a variety of sources across the board, distribution, direct customers. So that space is pretty much at the bottom, and you're starting to see some signs that it's coming back. As a result, you're also seeing some of the stocks jump rather sharply over the last couple of weeks. A lot of them are up like 10, 20% in the last couple of weeks. But you know, if you're buying them here at the bottom, 10, 20% is nothing. Texas Instruments, that's our top pick there. Another example, we think earnings can go up literally 100% at Texas Instruments. So
wow.
We could be really at the beginning of a multi-year upturn in analog.
Chris, I want to get your take on a potential breakup of Intel, because you seem to have a more bearish take than at least some of the investors do, considering that huge surge that we saw following that report. Why don't you think a breakup of Intel would be in the best interest of shareholders?
Sure. So there's a lot of synergies. Basically, the proposal is separate Intel into manufacturing and then the design of the chips, right? So there are a lot of synergies. And the analogy I would use is building a semiconductor is like building a house, right? It takes 3 months to make a semiconductor. There's a lot of layers, there's a lot of steps. And so the design and the manufacturing is like the architect and the contractor. Probably in your best interest to have the architect and the contractor working closely together. It's the same thing with the designers of the chips and the manufacturers of the chips. I know, several people that work at various semiconductor companies, let's say on the design side, and they're always like going back to visit the factory as they are manufacturing these chips. So I think if you break up Intel, you lose a lot of those synergies, and it's going to hurt the company. I think that if they want to like sell off some of the non-core aspects like an Altera or Mobileye, that's no big deal. But I think you do need to keep the core businesses together.
Well, but at the same time, Chris, I believe you think that they need to get rid of the so-called merchant foundry business. In other words, right. I think what you're saying is they should keep making their own chips and working on that process, but they shouldn't necessarily be manufacturing chips for other people. What happens to that business then if it's not, a TSMC or someone who buys that? Or could that be a potential outcome?
Yeah, that's a great point and a great question. So we have this top 15 rules of semiconductor investing, and one of those is it's an axiom in just in tech investing overall that tech companies and semi companies are generally good at like doing one thing really well. And if they try and get outside of their core competency, it tends to meet with failure. Intel is fantastic at manufacturing leading edge microprocessors. They've been doing it for 50 years. If you get outside of that, they've been trying to do merchant foundry, making chips for other companies for the better part of 20 years. And it hasn't worked for 20 years. They bought a company, Altera, about 10 years ago. So they own Altera. They've owned it for 10 years. They still can't make Altera's chips. Altera's still making them at Taiwan Semi. So it's not like, I'm pulling this out of a vacuum or something like that. So I think if they do get rid of the merchant foundry business, it's not that big a deal. They don't really have much of a business there, right? So you can just shut it down or spin it off. I don't know if they could sell it, but really it's a fairly small business. The biggest part of it is the billions of losses that they're having every quarter. You shut that down. We've done the analysis. You have a path to $3 or $4 in earnings. That's a $50, $60 stock. I think it's great. I think Intel holders should and would love it. And, in all fairness to Pat Gelsinger, I think Pat had them on that track back to drawing at least close, if not even with the competition by the end of this year. Now, I think his sort of fatal blow was he was still pursuing the merchant foundry business and it was killing him. But I think, Intel has a solid chance at getting back in manufacturing now that Pat's gone and they've had some other high-level defections. That path to recovery is now in jeopardy, unfortunately.
Yeah. Well, Chris, it has been a fascinating story to watch, certainly. Thank you so much for your perspective. Appreciate it.
Happy, have a good weekend.
You too. Now time for some of today's trending tickers. We're taking a closer look at a couple of healthcare stocks, starting with United Health Group. That stock is moving lower due to reports that the Department of Justice is investigating its Medicare Advantage insurance business. Joining us now with more is Yahoo Finance's Anjali Kamlani. This has to do with billing. Talk us through what exactly is being looked into here.
Well, there's a question on what's being looked into here. So let's recap what happened. The Wall Street Journal reporting this morning that they have news of an investigation into Medicare Advantage billing. The United Health then countering with their own statement saying the Wall Street Journal continues to report misinformation on the Medicare program. They've done a couple of reports over the past year, and they said they're not aware of a launch of any new activity as reported by the Journal. We also got a note out from JPM analysts saying that they're cautioning investors against jumping to conclusions on this report, and they expect that if there is anything, the United Health is going to be defending their practices, of course, but that it could just be a regular audit at this time. So there's a question on what exactly is happening. We have seen, of course, the stock down on the news and awaiting any confirmation on what exactly is going on.
All right, Angela. Next up, I want to get your take on Hims and Hers Health. That stock is tumbling today after the FDA announced the shortage of semaglutide injection products such as Novo Nordisk's Ozempic and Wegovy has been resolved. So, Anjali, what can you tell us about this and what that means for a company like Hims and Hers?
Hims and Hers definitely going to get hit with that. Now, they do have a little bit of leeway. What we do know is that the FDA confirmed what we had been anticipating, which is Novo Nordisk saying that their shortage is also over. That makes them join Eli Lilly, which had already got its GLP-1s. Now remember, these are the blockbuster diabetes and weight loss drugs that are new and really popular. Patients still say they're in shortage, but the companies have been able to convince the FDA that they are not. And so right now what we're looking at is the impact on telehealth platforms like Hims taking a hit. They do have a 90-day window to continue selling these products, but others like Sesame Care and Ro also, who are also part of this, are definitely going to get dinged. Sesame Care actually wrote a letter to their patients saying that, just so you know, manufacturers are allowed to still sell this for 90 days, and the medication remains active for a year after being purchased. So it could,
people could hoard them.
People could hoard. You can stock it up. So that's really where things are right now. And what it means is that we're going to be watching how this impacts Lilly and Novo's business over the coming year to have the compounders out of the marketplace, so those knockoffs that were allowed because their drugs were in shortage. What happens now with their selling, with their throughput as well, because we know manufacturing is a big key in that.
And to be clear, those platforms cannot sell the branded versions of the drugs.
They can sell the branded versions. It's just because they're in shortage, they're sort of lower priority. Ro does have a partnership with Lilly to sell direct, so that's one area where they could potentially see a higher throughput. But the reason why they partnered with the compounders is because it's a cheaper option and easier to get access to. So that's why that has been on the market this whole time.
Yeah, interesting to continue to track that supply and demand picture there. Anjali Kamlani, thank you so much. Well, a busy day in the crypto space. Coinbase saying it's reached an agreement with the Securities and Exchange Commission that will drop its enforcement lawsuit. We'll hear from SEC Commissioner Hester Peirce. That's next.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. I'm joined now by SEC Commissioner Hester Peirce, who has been charged with leading the new SEC's crypto task force. Commissioner Peirce, thank you so much for sitting down with me. It's great to have you back on Yahoo Finance.
Jen, it's great to be here. Thanks for having me.
Coinbase announced this morning that the SEC has dropped its lawsuit against the firm to register as an exchange with the commission. I understand there's supposed to be a vote next Thursday on this. Would you vote in favor for this, and could we see this lawsuit dropped once and for all next week?
I'm sorry, but I can't speak about ongoing litigation.
Would you support dropping such a lawsuit?
Unfortunately, I just can't speak about ongoing cases.
Curious whether the commission is changing its stance on how it views digital tokens. Before, many were viewed as securities. Is the SEC changing its view to seeing many viewed as commodities now?
Well, I've always had a little bit of a different approach than some of my colleagues on how we think about these things. And so what I'm hoping that we can get to is a place where we have greater clarity around how we're thinking about things in a legal framework that is workable, that is consistent with the statute, but also enables people to figure out what something is categorized as without hiring lots of lawyers and having the fear of litigation hanging over them.
To your point, under the last administration, we saw that the SEC declined to write customized rules to govern crypto. Many tokens were seen as securities, and thus companies were told to abide by the rules on the books. Could we see the SEC write customized rules to govern crypto this year? And could we see clear definitions for what constitutes a security or not?
Well, I think we will work on trying to provide more clarity, and there are several ways we can do that. We can use guidance to help people understand where things fit, whether that's staff level or commission level guidance. And we can also write rules, which for all of these things will be trying to interact with people and find out where they need clarity and get people's suggestions about how to move forward. Some of the work is going to be done here at the Commission. Some of the work will probably be done in Congress as well. So timelines are a bit hard, but we are definitely working and trying to work quickly to get people some clarity early on.
Do you think we'll see something this year?
Again, whether or not a rule gets done this year, I don't know. And I should say that I'm speaking only for myself. We're getting a new, we have a new chairman likely coming in relatively soon, and he'll have ideas about where the agenda should go and what should be on the agenda. But I think rulemaking could be part of what we do.
I want to go back to your statement on February 4th, where you said you're thinking about recommending action to temporarily offer relief for digital coin offerings to be deemed non-securities for the time being, again, temporarily, so long as they filed with the SEC certain information and kept that information updated. And that could actually be retroactive, you said in your statement. Are you planning to move forward with that? Is the SEC planning to move forward with that?
Well, it's something we're considering, and it's something I've been thinking about now for a while, which is, can we give people at least the ability to try to launch a project, get network effects, get people using a token, because that's really the point of a lot of this, is to try to get decentralization and lots of participation, and that can sometimes run into the securities laws as we've applied them. And so thinking about how we can get projects a road forward, and one that involves disclosure so that people who are buying the tokens have some sense of what they're buying. I think that could be a real positive to do that early on, even if it's just a temporary fix while Congress is working and while we're working on rulemaking. So we're very interested in what people have to say about this, but this is one of the things that we're looking at.
Is it under serious consideration?
It's under serious consideration by me. Certainly, yes.
I also want to ask you about, under the last administration, a lot of crypto companies, including Coinbase, had real difficulty registering with the Commission. Do you anticipate any changes associated with that process?
Well, I do think that we need to do more than just tell people they can come in and register and then when they get here, shut the door, which has been sort of the past practice. So I'm hoping we can have a practice where people can come in and talk to us and
we can think about when registration is necessary, and if it is necessary, are there accommodations that we need to make using the tools that Congress has given us to make accommodations. Again, our securities laws, we have objectives that we have to meet as a securities regulator, and we're not going to throw those out. That's not our plan. But we do think that we can both achieve our objectives of protecting investors and protecting the market's integrity, and also achieve the objective of allowing people to do things in this space.
Under the last administration, spot Bitcoin and Ether ETFs were approved, but they were not given in-kind redemptions. Could we see that changed? And what about the potential for greenlighting options for Ether ETFs?
So in terms of staking, that is something that people raised with us early on after these products went through. And it's something that I'm open to. I think I'm happy to talk with people about that. Adding that, I know that that's something that exists in products in other jurisdictions. In terms of options on ETH, ETPs, that's something we're open to as well. We're getting lots and lots of incoming exchange-traded product applications, and we'll be considering them on their individual facts and circumstances and processing them just sort of as we routinely process these things.
The president this week signed a new executive order stating that independent agencies should submit major regulations to the Office of Management and Budget for review. How will that impact the SEC's rulemakings, not just for crypto, but in general?
More broadly, yeah. I mean, I've been a believer in the importance of economic analysis, and that means asking the question, what problem are we trying to solve? What tools are available for us to solve that? How can we pick the best tool? And OMB, and specifically their OIRA office, can be really helpful in helping us think through how to do that, because they're experts in this. So I'm certainly looking forward to working with them on helping us make sure that our economic analysis is really serving the fullest potential that it can serve.
I understand, based on Doge's website, it looks like Doge has been inside the SEC. Can you confirm that? And what do you expect from Elon Musk and his team in terms of cuts and the impact potentially on surveilling capital markets?
Well, I can't confirm that, and I think one of the interesting ways that the SEC is set up is we have a commission. There are 5 of us. Now there are 3 of us, but if we're fully staffed, there are 5. But the chairman does have authority over the budget, the staff, and the agenda, and so I think those contacts would be with the chairman's office. In terms of thinking about how we can run the agency efficiently, that's something that we're always thinking about. It is very important. We feel that we have a real responsibility. We have excellent staff here, and we want to make sure that they're working on the most important projects that they can work on. And so thinking about how to do that best is something that is always front of mind for us.
Your colleague and acting chair, Mark Ueda, ordered SEC lawyers to delay oral arguments over a rule that would require companies to disclose the impact of climate change on their business. Is that a signal that the SEC is going to be rolling back that rule? And what other reversals could we see from the last administration?
I think the commission hasn't made decisions on that, but I have had concerns about that rulemaking, certainly, and I expressed them pretty vociferously at the time that we proposed and adopted those changes. I'm sure we'll be thinking about these kinds of things. And in terms of what we're going to do on other rulemakings, again, that's the agenda is very much a work in progress. It's something that we're thinking about what should be on the agenda, what should be off the agenda. There are rules that have been proposed but not finalized. We have to think about how and whether to move forward with those. So there's just a lot of work to do, and it's hard to know where all of that will fall out. I will say that I think capital formation is something that will come back onto the agenda in a way that will be really positive. It's been off the agenda, and I think we'll be spending some of our resources on trying to improve capital formation.
I'm curious, the U.S. President Donald Trump is participating financially in the same industry that the SEC is being asked to oversee. His media company is set to launch the Bitcoin ETF, I presume a vehicle that would need to be approved by the SEC. Does this create any challenges for SEC oversight as you're looking to also work with the White House and the White House overseeing some of what you do?
I think what we do is we look at every incoming application on its facts and circumstances, and we take into account, the unique facts and circumstances associated with each, and we'll do that with respect to anything that comes through the door.
Commissioner Peirce, thank you so much for your insights. So appreciate it. Hope to speak with you again soon.
Thanks for having me.
That's SEC Commissioner Hester Peirce. We will be right back after this.
Gold is looking for its 8th straight week of gains, and our next guest is lifting his year-end gold price forecast to $3,100 per troy ounce. Joining us now, Don Strivin, co-head of global commodities research at Goldman Sachs. Indeed, your team just raised this forecast, but talked about that there even could be more upside. Talk to me about the role of central bank buying of gold in your outlook here, Don.
Yeah, thanks a lot for having me. So the main reason while gold prices continue to hit new all-time highs, and the main reason why we look for additional upsides to $3,100 per troy ounce by year-end, is this structural increase in gold purchases by central banks, in particular by reserve managers in emerging markets. What happened in 2022 is that when Russia's central bank reserves invested, for instance, in treasuries or fixed income in other developed markets like Europe, when those reserves were frozen, it was a wake-up call to EM central bank reserve managers because they realized that their assets would not necessarily be risk-free. And so they have shifted part of their reserves to buying gold, an asset which cannot be frozen or confiscated. And so we have seen a 5-fold increase in the rhythm of gold purchases by central banks. We think this is a structural shift, and we expect ongoing solid, above-trend central bank purchases of gold to continue to push gold prices higher.
So central bank buying, a structural shift, as you say. What are some other catalysts that will push up gold demand and lead to some of those higher prices?
So we also have a boost from our expectation that interest rates will come down globally. In particular, our US economists look for 2 Fed cuts this year. And if interest rates come down, that increases demand for gold from investors because the interest rate is essentially the opportunity cost of holding gold. That's a key driver. We also see a lot of value in investing in gold as a hedge against policy uncertainty, trade tariffs, uncertainty about inflation. And so if policy uncertainty were to remain at high levels, and if speculative positioning, which tends to be high when uncertainty is high, if speculative positioning were to stay at currently high levels for longer, our model would point to a gold price by year end of up to $3,300 per troy ounce.
And does that imply that even if rates don't move down, as your economists are predicting, that even just the policy uncertainty could still propel gold to those levels?
Yes, that's right. We think the two quantitatively key drivers of gold prices are, number one, structurally higher central bank purchases, and second, uncertainty. Interest rates matter, and for instance, if the federal funds rate were to stay flat this year, we would still be forecasting gold prices above $3,000 per troy ounce. The quantitative big drivers are very much central bank buying and policy uncertainty.
Don, I also want to get your take on oil. You see the price of Brent ending the month at $79 per barrel. We're currently trading around $74 a barrel. So what would be the biggest drivers to the upside in your view?
Yeah, so we continue to expect Brent to trade in what we've called the 70 to 85 range, or WTI that corresponds to 65 to 80. And we look for some short-term upside in our base case, because inventories are quite low. And in fact, our valuation model for oil suggests that oil is currently underpriced by $6 to $7 per barrel. In fact, if you just add up all the oil inventories you can see globally, both crude and refined products, they have fallen to mid-2022 levels when oil prices were in triple digit territory.
And also, of course, there's some geopolitical uncertainty with regards to things that affect oil as well. And one of the most interesting things you recently wrote about was the effect of what could happen in Russia. If there is an end to Russia sanctions, if there is a resolution to the Russia war in Ukraine, you don't necessarily think that's going to mean a flood of oil supply coming to market. Why not?
Yeah, that's correct. So if you were to see a ceasefire in Ukraine, our working assumption is that you would likely see a significant return of natural gas flows from Russia to Europe, for instance, via Ukraine. And that could lead to a 50% drop in European and global ex-US natural gas prices and cause 0.5% of GDP upside in Europe. However, while sanctions are constraining natural gas flows out of Russia, we don't think sanctions are constraining Russian flows out of Europe. Why? Because the key constraint on Russian oil production is production quota that Moscow has agreed with Riyadh in the context of the Russia, Saudi Arabia, OPEC plus agreements. And so if you were to see a ceasefire, if you were to see a removal of sanctions, for instance, on purchases by Europe of oil, it could affect who buys the oil. Maybe Europe starts buying it as opposed to India and China. But we don't think it would change the volumes of oil in the market and would therefore not have large negative effects on oil prices. So a big contrast here between a potentially big downside for natural gas prices and more limited downside for oil in the context of a potential ceasefire in Ukraine.
Don, how worried are you that an increase in inflation and a slowdown in global growth potentially can impact the demand picture there for oil?
Yes, so if, for instance, global growth were to come in a percentage point weaker than our forecast of growth, sort of in a 2.5% to 3% range, over time, that could cause up to roughly $10 per barrel downside, but it would take time. And a 1 percentage point slowdown in global growth is a pretty big shock. And it would take time because oil prices tend to pretty much price what we call spot fundamentals, inventory levels as we see them. And it would take time for global GDP to be softer than our base case, and therefore for oil demand to be softer than our base case, and for inventories to build. And in fact, gold would do well in such a scenario.
Right, that makes sense. One more thing I wanted to ask you about is President Trump's sort of attempts to influence global oil markets, right? He has talked about trying to get the Saudis to pump more to bring prices down. He certainly talked about that here in the United States as well. especially if your prediction is that we're going to see oil prices tick up here closer to $80 a barrel, are his attempts to keep that contained going to be successful?
So we do think that the current U.S. administration is very focused on avoiding oil prices and gasoline prices that are too high. What we find, for instance, when looking at media mentions of gasoline prices, is that media attention, for instance, for U.S. retail gasoline prices really picks up when U.S. retail gasoline prices are above $3.50 per gallon. Currently, we're in the low threes. So we think we're still at a level where energy prices are not a major affordability or political issue for the U.S. administration. And so we think that prices in the low 80s are okay from the energy affordability political perspective. And then I think what's underappreciated is that the other big goal of the U.S. energy administration policies is U.S. energy dominance, making sure that the U.S. continues to expand production. And that requires, based on our models, oil prices roughly above $70 per barrel. Because if you drop into the 60s, let alone 50s, U.S. shale supply growth would slow down a lot, and the administration would not achieve its objective to continue to expand U.S. energy exports and U.S. energy dominance. And so our 70 to 85 forecast range is pretty much the sweet spot, the intersection of both energy affordability for consumers and energy dominance for the producers.
Really fascinating stuff, Don. Thank you very much and have a great weekend.
Thanks a lot. You too.
We're wrapping up today's market domination, but don't go anywhere. We got you covered with all the action following the closing bell. And by the way, into the closing bell, we remain around the lows of the session. The Dow and the S&P 500 having their worst single session going back to December 18th. In the case of the Nasdaq, it's going back to January 27th on a worse than expected economic data this morning. All three major averages selling off. We'll have the close for you next. There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery in a sec going to help us get us up to speed on the action from today's session. I'm going to start with where the major averages ended the day down in a word. So let's run through it. The Dow off by 749 points, down 1.7%. The S&P down 1.7% as well. Both of them having the worst day since mid-December when the Fed had its meeting and sparked a market sell-off. The Nasdaq, the worst since late January, off by 2.2%. Now, we had this trio of economic reports that we have been talking about that came out this morning. First of all, not in chronological order, but we did have consumer confidence coming out and weakening, and in particular, the expectations for long-term inflation over 5 to 10 years ticking up to the highest level since 1995. That increase driven mostly by Democratic respondents to the survey. So an interesting portion of that, which perhaps you could, look at through a political lens. But then we also had two other reports this morning. We had existing home sales falling 5%. In part, we're still seeing high mortgage rates. And then we also saw PMIs, in particular, the service sector showing contraction. All of that equaling the drop that we saw in markets today. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. I'm going to take a look at the bond market here. Excellent equities market wrap up, and we'll get to the sectors in a second. Just want to point out that bonds actually dropped, bond yields dropped 8 basis points. We're now down to 4.42%, and that's off of that report, and not directly because of it, but it's interesting that it happened on the same day where we had that report of increased inflation expectations down the road. When you take the 10-year, it can be composed of inflation expectations or break-evens, and then the TIPS yield, which is the real yield. So having just spouted all that jargon, I'm going to move on real quick. Only staples and utilities finish in the green today. Tech took the brunt of the selling today. That was down 2.72%. Consumer discretionary also off pretty big, more than 2%. And so were energy and industrials. So 4 sectors out of the 11 experienced pretty steep declines. And this is in the context of a very low volatility rally that we've been having. But I would mention that we've also, well, let's see here. Well, it looks like I lost the interactive. So I'll tell you what, guys, I'm going to send it back to you right now.
All right, thanks so much. Well, a tough day on Wall Street as the major market gauges posted their worst day since the December Fed decision. Joining us now is Michael Cugino, the Permanent Portfolio Family of Funds President and Portfolio Manager. So, Michael, what's your takeaway from this risk-off trading that we're seeing to end this week? And we can't forget that earlier this week we saw some records.
Yeah, good afternoon. I don't think it's really that surprising at all. And I think investors should really expect this, and maybe it goes a little bit further. You haven't had a correction in probably a year and a half, and stocks have bled up, and especially the last several months, bled up quite a bit in a variety of sectors, although clearly tech the biggest, but the broader market moved as well. And so a correction, a consolidation, a sell-off, especially in light of increasingly negative economic news or a day of bad prints, for example, not surprising at all. And I think we could see more to come if we continue to see that kind of information. On the inflation front, remember a week and a half, we got kind of let's hope it's a one-off, but inflation numbers that appear to be higher than the market expected. And that calls into question the interest rate cuts, or how many cuts going forward and how quickly, higher for longer interest rates. And let's hope that was one print. But if you start to get some more of that coupled with some of this other data, you start to begin to worry about a slowdown and a recession. So not surprising the market's behavior this weekend today.
So are you sort of taking a more defensive posture right now, Michael?
Well, we run several strategies, but our most well-known is our asset allocation diversified strategy, permanent portfolio, which is exactly that. It's a defensive asset allocation fund that specializes in diversifying in a bunch of different asset classes, not only stocks and bonds, but also commodities, precious metals, real estate, and non-U.S. debt like Swiss sovereign debt currencies, and high-quality fixed income. So, we're prepared for this sort of a scenario in this environment. And actually, our firm expectations have been for higher for longer interest rates and stickier than expected inflation. So we're not really surprised by this. And so our asset allocation model has really factored this kind of a behavior in as part of its strategy.
There's been more talk about increasing overseas exposure, especially with valuations stretched here in the U.S. Are you encouraging your clients to look abroad, or do you prefer more domestic plays?
The way well, several of our assets, such as precious metals and energy and commodities, I would view as global assets anyway, even though they're priced in dollars. But in our equities and even our fixed income, we tend to focus on U.S. companies with strong international businesses. So that allows us to play sort of international markets, international growth without worrying about currency fluctuations. And so I think it is an area where investors look with the market run up. I mean, the S&P 500, based on the S&P 500 right now, based on our cut of earnings, is probably trading at about 22 times forward PE. That's rich. And when you couple that with a strong U.S. dollar move, it makes sense. You would look for areas in the stock market that have not kept up with the moves we've seen in the last year and a half, and also betting on a weaker dollar over time, and that would benefit foreign securities as well.
And turning to some of your individual picks here, I'm interested, you've got Broadcom on the list. Broadcom, which was a huge winner last year, has fallen a little bit this year. What do you think is going to be a catalyst for the stock?
Well, I mean, to some degree, after runs that some of these companies have had, you expect a consolidation and a slowdown. So we're not surprised by it. We think that semiconductors are going to continue to be strong. It's the nuts and bolts and infrastructure of a lot of where technology spend and excitement is with respect to AI and other areas. And it's not only just AI, it's data centers, it's more interactive software, application software, et cetera. So we think the chip sector is going to be strong. There's no question the valuations of some of those companies are rich. And so I think, investors, want to be looking for pullbacks where the pricing gets a little bit more reasonable. Looking at something like today, or maybe if you have another 5 or 10% down, that makes more sense. So we think longer term, those businesses are solid, but there's no question they ran up a little bit, and not surprising, they might consolidate. So in our view, it doesn't change our outlook on the stock.
Michael, thanks so much for your insights. Appreciate it.
All right. Have a good weekend.
You too. Investors also keeping an eye on what's happening with Elon Musk's moves in the federal government. The DOGE government efficiency effort could lead to a $5,000 cash rebate for taxpayers, but that may be too good to be true. Yahoo Finance's Rick Newman joins us now with more. And Rick, we've been hearing a lot about this rebate. Michael Darda, who we spoke with earlier, he called it a gimmick. What say you? Help us make sense of all this.
I don't think it's going to happen. I think Trump needs to get some good press here, and this sounds like something that might amount to some positive spin. First of all, the premise for this $5,000 rebate is that there will be $2 trillion in annual savings that DOGE is going to somehow find. The whole federal budget is $6.7 trillion. And if you found $2 trillion, you'd be having to do stuff like cut Medicare and Medicaid and Social Security, which is just not going to happen. Musk himself, Elon Musk, has lowered the target. His original target was $2 trillion. His target now is $500 billion. So that's just 1/4 of the number that $5,000 rebate is based on. So cut the rebate by 75%, and 5,000 is now 1,250. But budget experts don't even think Musk is going to come close to $500 billion. They think he'll be lucky to get 1/10 of that, or $50 billion. And now you're talking about what's basically a meaningless amount of money rebated to consumers. Plus, guess what happened when Joe Biden sent those famous stimmies out to everybody in 2021? Those were actually the third round of stimulus checks during COVID. We got inflation, which went all the way up to 9% in 2022. So if Trump finds he's not able to send out these $5,000 rebates, maybe it will mean he's getting lucky, because it will be one less inflationary factor in the Trump economy.
Right, and that was one of Michael Darda's objections to that as well. At the same time, we've got Howard Lutnick being sworn in as Commerce Secretary right now, and apparently one of his comments is, and he's echoed something that President Trump has been recently bringing up. He said the goal is to balance the budget. Rick, I know you've been looking at that.
Sorry, that's not the goal. That is not the goal.
Tell us.
If the goal were to balance the budget, we wouldn't be talking about another round of tax cuts. That is, the math is straightforward here. The tax cuts, just extending the Trump tax cuts, is going to add about $4 trillion to the national debt over a decade. Trump has another 12 or 13 tax cuts that he promised on the campaign trail. If we get all of those, it's going to add $10 trillion to the national debt. That's $1 trillion per year. These guys are not serious when they say they want to balance a budget. And by the way, here's the real tell. If they were serious, they would not be gutting the Internal Revenue Service. The IRS says there's a so-called tax gap, which is the amount that taxpayers owe but they don't pay, which could be as large as $500 billion a year or more. That's money, that's not raising taxes, that's tax money that people owe and they're trying to dodge. If you cared about the balancing the budget, you wouldn't be getting rid of the tax police who go out to find that money. You would probably be adding more tax police. So there's no evidence that these guys are remotely serious about balancing the budget. By the way, Joe Biden wasn't either.
Well, nobody has been in a long time, Rick. But you know, on the flip side, there are some proponents of this administration's policies. I haven't heard the phrase pro-growth thrown around as much lately, but certainly in the wake of the election, that was a phrase that was front and center for the market bulls, that this administration's policies were going to be pro-growth and that the sort of budget imbalance would in part be made up for by that growth. What is that outlook looking like at present?
Yeah, I mean, so there is some. I would get away from the phrase pro-growth because you're getting into the sort of the supply side economics, which basically never work. The idea that if you just unleash businesses, they're going to generate all this growth and it's going to trickle all the way down. That basically doesn't happen. But deregulation is one place to look. I mean, that's not necessarily a bunch of smoke and mirrors. If you do deregulate, you make it easier for companies to do business. Their costs go down. And that would help economic growth. Another big one here is permitting reform, which everybody talks about. It turns out it's really hard to do. So what Elon Musk is doing, just going through the bureaucracy and like taking a jackhammer and lopping off like 1/3 of every agency, that is not going to do anything to solve permitting reform. Permitting reform, it's a huge issue in energy, whether it's fossil fuel energy or green energy. It matters for both. It's the reason we can't build pipelines. We can't build new electricity connection mechanisms. Guess what? We need the federal government to get more involved and solve the problems at the state and local level, create incentives for states and cities to make those decisions faster. Housing is another one. We know there's tons of permitting issues getting more housing built. There's nothing that's coming out of Trump so far that will address that. So, deregulation will be pretty good. Tax cuts, yes, there will be some growth, but when the deficit goes up, I mean, we got a bigger corresponding problem there than we have ever had with the effect on the bond market and 10-year Treasury rates, which you've already been talking about. And I've been talking too long about all these problems, so I'm going to send it back to you guys.
We look forward to many future columns on all
these issues. I'm on a roll, but I mean, we got 4 years here.
I love it. Rick, yeah, you got to save a little bit. All right, thanks a lot.
See you guys.
Straight ahead, Mercado Libre, one of the standouts today in a sea of red on Wall Street. The company reporting blowout earnings, and we've got the CFO next. More market domination overtime coming up. Shares of Mercado Libre surging to a record high following strong fourth quarter results. The Latin American e-commerce and fintech giant reporting record quarterly results for revenue and for net income. Here with a closer look at the key drivers is Mercado Libre CFO Martin de los Santos. Thank you so much for being here, Martin. So obviously the stock climbing to a new record as you came out with these results. So you've got these two sides of the business, and obviously when you look at the economies in Latin America, there are a lot of cross currents going on. Where is the demand coming from, in particular on the e-commerce side of the business? Let's start there.
Hi, thank you for having me. Yes, as you said, we presented results yesterday that were very strong, closing a great 2024. This was a very special year for us because we're celebrating our 25th anniversary, and it was very strong in both sides of our ecosystem, as you mentioned. Both commerce and fintech are performing extremely well. In commerce, we reached 100 million buyers last year, growing at 24% year on year. On fintech, 61 million monthly active users, growing also at 34% year on year. And we deliver very strong financial results, as you mentioned before, as we continue to invest in logistics and strategic initiatives such as credit cards and so on. On the commerce side, as you mentioned, I think the biggest trend is people moving online. When you look at penetration of e-commerce in Latin America, continues to be very, very low in relative to the US or China or Europe. So I think that's the main driver of growth. And we, as the leading player in that, in Latin America and e-commerce in Latin America, we play a special role on moving people online. And we continue to invest in building a fulfillment infrastructure. We have the largest and more sophisticated logistic infrastructure in Latin America that enables us to deliver, for instance, the 1.8 billion packages that we delivered last year. Half of them were delivered within 24 hours. That was something that was undreamed of several years ago in Latin America. So many different things that we're doing, investing in our product, are helping us drive growth. And we've seen very strong growth in Mexico and Brazil, which are the main countries where we operate, growing at 32 and 28% respectively, at a much faster rate than the market. And then we also have seen a lot of strong recovery in the second half in Argentina. So very, very satisfied with the results on the commerce side. And we can speak later about the fintech side, which is also performing very well.
And I want to follow quickly on that e-commerce, that strong growth that you're seeing. Any interesting types of consumer behavior patterns, any type of trading down? We talk a lot about these macroeconomic concerns, tariffs, inflation, anything that you're seeing there?
No, we haven't seen much of that. We've seen some effects in some of the devaluations of the currencies might affect particularly products coming into the countries from abroad, from Asia, and so on. But for the most part, we sell general merchandise. So we tend to see, as I mentioned before, I think the stronger trend is people moving online. And that's a lot stronger than any macro headwind that we might have from here and there. We've been operating in Latin America for 25 years. So we've seen a lot of ups and downs. I think the focus that we have on our product and improving the offering on our platform, the payment methods, improving the logistics, that's a lot more important to bring volume through Mercado Libre than actual macro factors.
I'd like to ask about the fintech side of the business too, and credit quality in particular. When you look at markets like Brazil, where we're looking at a potential rising rate environment, are you seeing a decrease in credit quality? Have you tightened your standards at all? What are you seeing?
We haven't seen any deterioration of our credit on our book. In fact, our book continued to grow this year at a very rapid pace. Our overall credit book grew by 74%. Our credit card grew by 120% year on year. So very strong growth with NPLs under control and very healthy spreads. In fact, we improved margins quarter on quarter. Having said that, we have taken a little bit more cautious stance given the macro conditions. We have a lot of flexibility on our credit products since the duration of our product is very short. So we can adjust very rapidly to deteriorating market conditions if they happen. But we haven't seen them so far on our own book.
So I want to pick up on that point because you did reiterate your strategy of continuing to invest in the business to drive that long-term growth. But how are you navigating some of those potential cost pressures? And you mentioned some possible macroeconomic deterioration. I mentioned those tariff headwinds. Anything that you guys are doing to safeguard your business for the future?
Yeah, I think that for the most part, what we continue to do is to invest and to innovate and to improve the user experience. Our net promoter score is at all-time high. We continue to grow at a faster rate than the market, so we continue to gain market share. And the investments that we make are on the core of our business, right? Logistics, we invest on our product. We have 18,000 developers that are constantly looking at the user experience and trying to improve the service that we provide to our users. And then we are also investing on the fintech side on building our credit card portfolio. We have a very profitable credit business. The credit card requires investment because it takes a longer cycle to become profitable in a given cohort, and we're investing behind that. We manage credit with very, very conservative way. We grow very fast because we operate in a platform that's growing very fast, but we are very cautious in terms of risk management. But again, I reiterate what I said before. Macro, 1 percentage point more of interest rate, a little more inflation, doesn't affect the stronger trend of people moving online, which is something that we're trying to capture. We have a tremendous opportunity going forward on commerce as well as fintech. If you look at the fintech opportunity, penetration of credit in Latin America is very, very low. Only 13% of people in Mexico have a credit card. So the opportunity to include financially all those people is enormous, and this is where we're trying to capture at Mercado Libre.
Martin, finally, I did want to ask you about if there is any effect from potential tariffs, whether it is proposed 25% tariffs on Mexico, but also the sort of reciprocal tariffs that President Trump is talking about. Does that have any effect on your business in terms of the flow of goods?
It's marginal. We don't sell any products into the US, so that way it doesn't affect us. Most of the products, I would say 95% of the products are sold within each country. So these are local marketplaces. And we do have a cross-border business coming in from Asia into Mexico in particular. And more recently, last year, we opened a fulfillment center in Texas, selling into Mexico and Argentina. So if there were tariffs, it might be affected that small part of the business, but it's low single-digit part of our business. It's not really that relevant. So I think that the effects on tariff for us directly is not going to be, it won't have much impact on our business.
And Mercado Libre shares, they are up about 32% so far this year. Martin, thank you so much. Appreciate it.
Thank you for having me. Have a nice weekend.
Well, 2 more companies are rolling back DEI initiatives in the wake of Donald Trump's return to the White House. Joining us now with more is Yahoo Finance's Alexis Keenan. So, Alexis, you've been following this very, very closely. A lot of updates rolling out when it comes to corporate America and their stance on DEI. What's the latest here?
Yeah, so the latest are 2 more major U.S. firms, Citigroup and PepsiCo, joining some other major companies that have rolled back DEI initiatives. Citibank's announcement came about its changes in a memo from CEO Jane Fraser. PepsiCo, for its part, published a memo yesterday from Ramon LaGuarta. Both companies saying that they're going to end what they call aspirational workplace representation goals. For Citigroup's part, they're going to stop requiring that there be a diverse group in the pool of job applicants, or candidates, I should say, and also the interviewers at the company that interview the candidates. That no longer has to be diverse. That was a requirement at the company. They're also going to rename their DEI talent management team, and they're going to call it instead the talent management and engagement team. Pepsi also said for its part that it's no longer going to employ a DEI officer. That job is going away. And it's also going to expand its supplier base, the company said. So like you mentioned there, we have been tracking at Yahoo Finance the best we can these major companies that are abandoning their DEI policies. There's Walmart, Target, Goldman Sachs, Disney, Google, Meta, McDonald's, Boeing. That's just to name some of them. You can see some of them there on your screen. Many of these executives of these companies pointing to the decision-making process based on a 2023 Supreme Court decision that outlawed race-based admissions in admitting students to universities, and also to an executive order that was issued by President Trump ordering federal agencies to, quote, combat illegal private sector DEI. So one of the DEI advocates that's been very aggressive in this area, Robbie Starbuck. He claims that he was responsible for the rollbacks at PepsiCo. Also, not necessarily seeing a lot of stock moves in the wake of these decisions, but what we are seeing are lawsuits. Target already the subject of a couple lawsuits allegedly for hiring or not being transparent about the risks of doing away with these DEI policies or keeping them on the other hand. So Target seeing it from both sides. So definitely somewhat of a risk there, and these CEOs and these executives having to kind of tiptoe around the new policies that are rolling out, both from the government as well as from the Supreme Court.
Alexis, thank you so much for tracking all of this for us.
You bet.
Time now for what to watch next week. We'll be getting Berkshire Hathaway CEO Warren Buffett's annual shareholder letter on Saturday. The letter coming out in conjunction with the company's annual report and fourth quarter earnings, this year marking Buffett's 60th at the helm of Berkshire. Investors will be looking closely for any commentary on a variety of topics, including investment opportunities and when he may pass the baton to his designated successor, Greg Abel.
On Wednesday, the moment markets have been waiting for, NVIDIA earnings are coming. The AI juggernaut is announcing full year and fourth quarter results after the close. And after a steep sell-off following the emergence of DeepSeek last month, NVIDIA is clawing back some of those losses. Yahoo Finance will have special coverage of all things NVIDIA on Wednesday. Coverage begins at 4 p.m. Eastern.
And finally, we'll be getting a key piece of economic data on Friday with personal consumption expenditures. Economists expect overall PCE to hold steady at 0.3% on a month-over-month basis, while core PCE ticks up to 0.3%.
And that'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we'll be diving into. Another rough day for markets as new U.S. data sparked concern among investors over a slowing economy and sticky inflation. The Dow saw its worst day so far of 2025. It's lost over 1,200 points in the last 2 days. We'll dive into the rest of the day's market trends. Then a big day for crypto, but it's not all good news. We'll bring you the latest from the burgeoning sector. Plus, Berkshire Hathaway CEO Warren Buffett shares his annual letter tomorrow. We'll tell you what to expect from the Oracle of Omaha. Well, Coinbase announced Friday the Securities and Exchange Commission has agreed to drop its enforcement case against the company pending the approval of the regulator's commissioners. The agency had charged Coinbase with operating as an unregistered national securities exchange, broker, and clearing agency. Here's what SEC Commissioner Hester Peirce told Yahoo Finance earlier when asked if the SEC views digital tokens as securities or commodities.
Well, I've always had a little bit of a different approach than some of my colleagues on how we think about these things. And so what I'm hoping that we can get to is a place where we have greater clarity around how we're thinking about things in a legal framework that is workable, that is consistent with the statute, but also enables people to figure out what something is categorized as without hiring lots of lawyers and having the fear of litigation hanging over them.
Joining me now, Ryan Rasmussen, Bitwise Head of Research. Ryan, it's good to see you. So between hearing what Hester Peirce just had to say and the Coinbase, it looks like lawsuit going away, what does this mean for the industry?
Yeah, I think it's a really monumental moment for the industry that the SEC has dropped its years-long tirade against Coinbase and the lawsuit that they've been chasing after Coinbase on. And ultimately, we expected Coinbase to prevail from that lawsuit in the courts, but I think it's a huge signal to the market that the actual regulatory pivot that we've been hearing is going to happen, that it's actually happening in Washington already. So we're very excited about it. You spoke to Hester Peirce earlier. Obviously, she has a different way of viewing the market than the Gensler era SEC, and she's leading the crypto task force that will take on setting clear rules and regulations for crypto and creating a framework for crypto to finally be on a level playing field with the rest of the financial and technology industry. So we're really excited about that. And we think that we'll look back in 5, 10, 20 years at today's dismissal of the case against Coinbase as a real pivotal moment in crypto's long-term journey.
Let me ask you this, though, Ryan. I mean, does this mean we're going to see an explosion of coins? I won't use the word that people use to describe these types of coins at times. I mean, are we going to see more politician meme coins, for example? And is that a good thing for the industry?
Yeah. I mean, I hope not. I hope we don't see any more politician-based or rooted meme coins. I do think that what this means is that we'll finally see some of those use cases for crypto and some of the exciting innovations that crypto can bring to traditional industries. I think we'll finally start to see those break through. But I don't think this means that every crypto project is going to thrive now. I think competition and execution certainly still matters. But what we do know today is that we're finally on that level playing field. So we're really excited about where we go from here. I do think that we'll start to see fewer and fewer of those pump and dump type coins or those political meme coins or just other meme coins as the market starts to mature and we enter this next phase of growth of mainstream adoption and playing by the rules, if you will. And for that, I'm very excited. But I do think there's been a lot of riffraff in the crypto industry for many, many years. And part of this growth, if crypto does want to mature and enter the next phase of its life cycle, part of that growth will be leaving that in the past. And I think we're on the path to do that, but it won't be necessarily a smooth ride there.
Well, when we talk about bad actors, we got to talk about the other big headline today, which is a huge, huge hack of Ethereum in particular. $1.4 billion reportedly stolen from an exchange called Bybit. That can't be a good headline for the industry at a time when, as you say, it's trying to gain more credibility.
Yeah, that's absolutely right. So today, right on the heels of this news that the Coinbase lawsuit was going to be dismissed, we heard news of an exchange, of a centralized crypto exchange being hacked for $1.5 billion worth of Ethereum. And that is a really big deal. And I think that goes to speak to the growing pains this industry continues to experience as it moves into the next phase of its life cycle. It's one of the reasons why We need more rules and regulations around how banks, how exchanges, how other financial service providers need to protect customer assets, the different security parameters that need to be in place, et cetera. I do think we also will see more institutional grade custody-like services that exist in the traditional asset class world today for traditional assets. I think we'll start to see those bleed more into crypto. And certainly certain companies, more than others, take security and other types of service protections more serious than some of those in the past. But yeah, it's not a great look for the industry to see customer funds being stolen, particularly to this magnitude, and particularly on a day where the industry was rejoicing in this monumental moment from the Coinbase lawsuit.
I mean, I gotta say, Ryan, you don't hear about this happening at a bank, right? Or at an asset manager. You don't get these types of hacks happening. What you're seeming to suggest is that maybe, even though the industry has pushed for, as you say, more clarity and in many cases less regulation, is this an area where the industry needs more regulation?
Yeah, I think that's a really good point. It is similar to someone walking into a bank and robbing the bank for billions of dollars. And you're right, we don't see that in traditional asset classes, in traditional finance. It's one of the reasons why there's so much trust in the way things are done. And there's been very little progress on the technology front and on the innovation front in the financial industry for years past. But I do think that we're not necessarily asking for less regulation or no regulation. It's really around the clarity of regulation, of what needs to happen, and guidelines, both for how institutions should operate, how companies should operate, and around consumer protection, so that this type of activity can no longer happen in the crypto industry in the same way that it no longer happens across the traditional finance industry.
Ryan, good to see you. Thanks a lot for joining us.
Thanks, Julie.
Well, U.S. stocks closing lower, seeing a steep downturn that pushed all three major averages into the red for the week. Yahoo Finance's Jared Blickley joining us now for the trading day takeaways. Hi, Jared.
Thank you, Julie. Let's begin with seasonals. Now, we didn't necessarily foresee everything that was going to happen this week, but we did have a bias coming into the second half of February. So we're going to talk about that right now. And here's a chart from Ryan Dietrich that spelled out the month of February, had a rise, and this is just history. And we always say this doesn't have to happen, it's just a tendency, but rising into the middle of the month and then declining into the end of the month, that's February. And let me show you what's happening with the entire year. So this is my seasonality map, and there's different ways to slice and dice this, but here is green in what has happened this year, and you can see it lines up perfectly here. Doesn't mean that we have to go down into March and then rise, but it's just a tendency, and so when it happens like that, I tend to pay attention, a little bit more attention. That's it.
Yeah, and what's interesting also is that the pullback here, but even part of the gain, has happened without as much participation from the Mag 7.
Yes.
Right? We've been watching that trend as well.
Guess what? That's my second point here.
Yes, I'm taking you there.
Mag 7 on the rope. So let's take a look at the mega caps here. It wasn't the best week. This is a 4-day week, and remember, we actually had Monday off, which I don't even remember. But Apple managed to squeeze out a 40 basis point gain, 0.4%, but everything else kind of in the red. Remember Meta in that 20-day winning streak? It was down every single day this week. And if you look at the year-to-date gains, I'm going to show you, this isn't really that pretty. And remember, Berkshire Hathaway, even though it's up 5.6%, not part of the Mag 7. So you have NVIDIA, which is just, let's call that flat. And then you have Meta, which is up 16.7%. That's been carrying the water, and now you don't really have that much participation. Tesla down 16%. This was a bad day for stocks, and overall, I mean, you were talking about some of the comparisons. This is the worst day either since 12/18, that bad Fed day that you were noting, or DeepSeek, that DeepSeek Monday that we had last month. So any way you slice and dice this, we are seeing a lot of red today.
Yes,
but
we are.
It's not all red, because guess what? We have diversification. That name is diversification. And first, I want to talk about Lee Munson. Now, this is a gentleman who we just interviewed on Stocks in Translation, and he was talking about buying the 30-year when it hit 5% earlier in the year. Let's take a listen.
I'm like long the 30-year Treasury. You know, I love it when bond gurus say things declaratively, whether it's that guy over at JP Morgan, or let's just say, the Gunlacks of the world, that who would buy a 30-year Treasury? And
when it hits 5%.
Yeah, when it hits 5%.
That's who buys it.
And it's like, well, it's just a bunch of pension funds doing, liability. It's like, okay, great. So I have a bunch of goons in little blue suits looking at actuarial tables and nobody else. I'm like, baby, this is the sandbox I want to play in because it sounds like not much competition.
All right, so we had a little bit of a reprieve from bonds this week as well as China, but there's not a lot else going on that I can point to that's necessarily green.
But we have had a lot of investors and strategists come on and talk to us and say, you have to be diversified in this environment. Michael Darda, one of the folks saying that just at the top of the show, because it's a rocky environment.
Yes, and you can make the case for bonds. A lot of people say China's uninvestable still because of the regulatory overthink, but you gotta play with what we have, and we don't necessarily have a lot right now.
Yes. All right. Thanks, Jared. Appreciate it. Stick around. We got to look at the state of the housing market next on Asking for a Trend. Existing home sales numbers coming in today at 4.08 million, missing expectations. The fall on a month-over-month basis, marking the first since September. For more, we're bringing in Chen Zhao, head of economic research at Redfin. Chen, as we look at these numbers, obviously the mortgage rates are a big factor in this, affordability a big factor. How are you thinking through the sort of stumbling blocks to this loosening up in the housing market?
Hi, thanks so much for having me today. Yes, I think you're absolutely right that mortgage rates remain pretty high right now, and home prices remain pretty high, and they continue to increase. However, what we're seeing in the market right now is actually that after 2 years of a very slow loosening of the mortgage lock-in effect, we're actually seeing enough inventory pile up that what we see in the market right now looks more like a buyer's market than anything we've seen in the past 6 years. So nationally, there's about 4 months of supply on the market, which doesn't sound like a lot, but it's higher than anything that we've had in the past 6 years. And in certain markets, especially down in Florida or in Texas, you're actually seeing more than 10 months of inventory. And on top of that, what we're seeing is that homes now are selling at an average 2% discount relative to their list price. So all of that seems to point to buyers having a little bit more of an opportunity than they've had in a really long time.
So I guess then what's the problem? Is it that they don't realize that they have that opportunity, right? That they don't, that they're not cognizant because they're looking at prices that seem high to them and don't realize there's wiggle room? Is it the mortgage rates that are a stumbling block? Or is it, even if there's supply there, is it that the people who are selling maybe aren't willing to negotiate as much? What's going on there?
I think there's a few different things going on. So directionally, we're seeing that things are going in favor of buyers, for sure. However, if you are a buyer, what you're still seeing is that mortgage rates are still sitting around 7%. Today, Mortgage News Daily just reported that mortgage rates are actually at about 6.9%, which is the lowest they've been in about 2 months. But that's still pretty high in an environment when home prices are still really high and increasing. And also, you have to remember that consumers are still living with, a good deal of inflation. The Fed doesn't consider food and energy prices when they're thinking about inflation. But for an average consumer, when egg prices are really high, that really, makes people nervous about buying. And there's also, right now in the country, there's a lot of policy uncertainty. So, for example, if you're a federal government worker in DC, you might be feeling a little bit anxious about buying in this kind of environment.
Yeah, that makes sense. One other thing I know you've done a lot of research on that Apollo chief economist Torsten Slok, he sends out a daily chart, and his chart today was about the average age of home buyers. And I thought this was really fascinating that the median age right now is 56. It's up from 45 in 2021, so it's changed real quickly. And in 1981, the median age was 31 years old. So we have really seen this increase. What does that tell us, and what are the implications, not just for the housing market, but for the broader economy?
Yeah, I think this is really just reflecting how extreme unaffordability has gotten in the housing market. So we all know that during the pandemic, home prices increased a lot, about 45% over the course of 2 years. And then immediately on the heels of that, what you had is mortgage rates doubling, right? So what you're seeing now in the NAR data is, yes, the average age of home buyers seems to be increasing a lot. Redfin has looked at some data on mortgage lending, the HMDA data. And what that shows is that when you're looking at home buyers who are financing their purchase, the age of home buyers in that group has actually not increased a lot. So when you take that and you combine that with the NAR data, what that seems to suggest is that there's more buyers who are paying in all cash, and that those buyers are disproportionately older now. So what you're really seeing in the market is a market that really favors older people who are wealthier, who can bypass mortgage rates, and thereby that's just increasing inequality in the market.
Yeah, most definitely. Chen, thank you so much. Really helpful perspective here.
Thanks so much.
Berkshire Hathaway CEO Warren Buffett is due to release his eagerly awaited annual shareholder letter on Saturday morning, along with the company's fourth quarter earnings results. This year marks Buffett's 60th leading Berkshire, and the company is operating from a position of strength with record operating earnings in the first 9 months of 2024 and a near record stock price. Berkshire Hathaway is now valued at over $1 trillion, and those Class A shares have seen their price increase by 35,000-fold since Buffett took control of the company in 1965. Now, as always, shareholders will be closely scrutinizing the letter. Here's some of the topics they could be looking for. Any commentary on the broader environment, including weighing in on President Trump's proposed tariffs. Buffett was critical of past tariffs during Trump's first term. Secondly, Berkshire's cash pile. The company was sitting on about $310 billion in cash at the end of the third quarter. That's up from $167 billion at the end of 2023. And the year-end figure 2024 could approach $320 billion. That's according to CFRA's Kathy Seifert. Investors want to know why Buffett isn't seeing better opportunities to spend that cash in the market. Seifert also said investors want more information on margin pressures at Berkshire's auto insurance company Geico, including any information on losses tied to the California wildfires. And of course, with Buffett turning 95 in August, readers will be searching for any clues about succession timing. In last year's letter, Buffett wrote that his presumed successor, Vice Chairman of Non-Insurance Operations Greg Abel, is, quote, ready to be CEO tomorrow. Well, coming up, we're taking a closer look at today's consumer sentiment reading and consumer expectations for inflation. That's in our chart of the day. We're asking for a trend on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Our chart of the day, we're breaking down inflation expectations from today's final consumer sentiment reading. Yahoo Finance's Alexandra Canal joins me now with a closer look. Hi, Ali.
Hi, Julia. Yeah, American consumers, they had a dimming outlook on the U.S. economy as uncertainty related to Trump's trade policy lifted inflation expectations sharply higher for the second straight month. 1 year inflation expectations jumping to 4.3% in February. That's up from 3.3% last month, and it marked the highest reading since November 2023. January. But it wasn't just the one-year outlook, long-run inflation expectations that tracks expectations over the next 5 to 10 years. That climbed from 3.2% in January to 3.5% in February. And that's the highest reading since April 1995 and the largest month-over-month increase since May 2021. So our chart doesn't go all the way back that far, but you can see how we've been a little bit bumpy, but then continuing to track upward as these tariffs and all these policies come out of Washington. Joanne Su, she's a director of consumer surveys at the University of Michigan. She told Yahoo Finance earlier that unlike in years past, folks are not reacting to current price shocks. They're instead reacting to anticipated price shocks. So a lot of this depends on which tariff policies are ultimately rolled out and whether or not that trickles down to consumer prices. Now, we asked about this uptick in inflation expectations to Michael Darda from Roth Capital Partners, and he said it's something the Fed in particular is watching very closely. Take a listen.
The Fed is on indefinite pause now, more concerned about some recent warm inflation readings. You mentioned the University of Michigan data for February. That 5 to 7 year inflation expectation reading is at the highest level since 1995. Now, the mid-90s were not a particularly inflationary period, but I don't think the FOMC is, is flattered by the direction, which is up and to the right. It's not what they want to see.
And to that point, earlier this week, we had Fed meeting minutes released for the meeting that we had in January. And during those meeting minutes, FOMC officials, they think that policy is at a level that we can remain restrictive. And they also noted some upside risks when it comes to inflation, particularly around that tariff policy. So, Julie, more of the same here when we think about the unknown factors of trade. But everyone is looking at this very, very closely. And the anticipation, at least with this survey work, is that we're going to see a greater inflation over time as a result of all of this, changes in Washington.
Most definitely, and a lot of political division even within those inflation expectations. Thanks, Allie. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night and a great week.